So in the last couple of videos, we've talked about some of the monetary policies that the Fed uses. They have three main monetary policies that they're going to use. They use the required reserve ratio, changing that required reserve ratio. And if you remember from the last video, that changing that reserve ratio will change the amount of required reserves that they can have, or that they are forced to have, that they must have. That then changes the amount of excess reserves. Changing the excess reserves will change the amount of loans that a bank makes. That's the first monetary policy we discussed. It's not used all that often because it has major impacts on the banking system. The next major tool that we'll use, that the Fed uses in that monetary policy, is changing the discount rate or the federal funds rate. Remember that discount rate is the rate at which banks can borrow from the Fed. That federal funds rate is the rate at which banks borrow from other banks. The higher those interest rates are, basically the less loans that they're going to make for various reasons. The last monetary policy, and the most commonly used one, is this open markets operation, and that's what we're going to talk about today. What is the open markets operations? Well, it's basically the sale or purchase of government securities. Remember those treasury bonds? Anybody ever had those treasury bonds? You buy them, you hold on to them, and then they are supposed to gain interest. In a few years, you sell them back, and hopefully you made some money. That's a government security. So the purchase or selling of these government securities, of these government bonds, basically, is how the Fed that's the most common tool that the Fed uses to control the money supply. That's that open market operations. So the government securities are sold by the Federal Open Markets Commission, Federal Open Market Committee. Remember, we talked about that way back in this chapter several videos ago now, and we said that was those group of people that they come together and they determine whether or not we are going to be buying or selling on these government securities. So let's say that the government securities are sold by the Open Markets Committee. Reserve at the depository institutions, they fall. Well, how is this the case? Let's stop and think about this. If you are buying these open market securities, so the federal government is selling these securities, well, who are they selling it to? Are they selling it to other countries? No, typically they're selling it to U.S. citizens. So they're selling it to U.S. citizens. What do the U.S. citizens need to do in order to buy it? Well, they need to pay for it with money. So where do they get their money from? They pull it out of their checking account. They pull it out of their savings account. So they're pulling money out of the banks to buy these government securities. So what's happening to deposits at the banks? Deposits at the banks are falling, which means that they have less deposits, which means that they have less reserves, meaning less gets loaned out. So people withdraw their money to buy these securities. They withdraw them from the bank, lowers the amount left in the banks, and it lowers the amount left for them to loan out. So the opposite will happen if the Federal Open Markets Committee buys securities. So if the Federal Open Market is the government, the federal government, the Fed, if they are buying those securities, they are paying the U.S. citizens. The U.S. citizens receive this money, they go deposit it in the bank. Now because they're depositing that money in the bank now has more deposits, which means they have more reserves that they can loan out. And we're going to get into more of how much the banks are loaning out and how that really affects some money supply here in the next couple of videos. The Open Markets Committee is the most commonly used policy instrument that the Fed has in their tool belt. Now, something to keep in mind, this Federal Open Markets Committee, they're constantly buying and selling securities all the time. So whenever I talk about it and I say, yeah, they are buying securities now, and because they're buying securities, the amount of deposits at depository institutions, the amount of deposits at banks, they go up because they're buying these, and the people are receiving money and putting that money in the bank. Or I say that the deposits at these institutions are falling whenever the Fed is selling these government securities. Well, we've got to stop and think about it. They're actually buying and selling simultaneously all the time. So the reason that they do this is to keep the U.S. public from realizing that, oh, they're buying more than they're selling, or they're selling more than they're buying. They're buying all at the same time to kind of keep some confusion in there from the buyers and sellers. Otherwise, what would happen is if the general public knew that they're buying more than they're selling, then that means that they would kind of hold on to their government securities, try to manipulate the price on that federal government. Because they don't want that to happen, they're always buying and selling. So whenever I say that they are, say the Federal Open Markets Committee are buying securities, what that really means is that they are buying more than they're selling at that particular time. And then I'm going to get real quick into some other instruments that the Fed uses. These are very uncommon. It's not very often that they use it. Remember, the three main policy instruments, monetary policy instruments that the Fed uses is changing the reserve requirements, changing that discount rate or the federal funds rate, and then also changing these open market operation direction. Some other instruments that the Fed will use is the Fed will also determine the down payment for loans to purchase stock. They also will determine that the maximum rates that banks can pay depositors. So if you go to put money in a savings account, what is really happening is the bank is paying you a small amount of interest for however much you have in your savings account. Most banks right now are very low interest rates, which means you might put, say, $10,000 in the bank and you might receive $1 or $2 back in interest on that year. Not very much. So the Fed will also determine how much that these banks can pay depositors in order to kind of control the money supply that way. Another instrument that they use is quantitative easing, this QE. It is a non-conventional method used to stimulate the economy. So what they do is the central banks will add liquidity to an economy when conventional methods become ineffective. This quantitative easing is known as a last resort method. It's a last resort method just because it's so unconventional and it has major ramifications for it. Matter of fact, the last time that they used it was between 2010 and 2014. The U.S. government, they bought these known as toxic mortgage-backed securities. And whenever they bought those back, what they were doing is they expanded the amount of deposits left in that bank by buying back those toxic mortgage-backed securities. They put more deposits back in the bank. Let's stop and look at this time frame, 2010 to 2014. What was going on there? That was the Great Recession. That was right after the housing bubble. The housing bubble had just burst. It burst because of these toxic mortgage-backed securities, and because of that, the Fed actually came in there, bought a lot of those in order to put money back into the economy, put more money back into the pockets of the citizens in order to basically start stimulating the economy. It's a very unconventional method, and you won't see that very often. And as you can see, it only happens in times of basically major crisis like the Great Recession of what we experience here in the United States.